Hello, 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 and welcome to the Rent Success podcast. I'm so excited today to be talking to Manda Walker. Manda Walker is a mortgage advisor, mortgage and finance coach, and one of Manda's specialisms is helping people to get mortgage ready and get their feet on the property ladder for a property to live in. And the reason why I wanted to have Manda on the Rent Success podcast is I know that for many of you, you want to start a property business and make cash flow from property, but for some of you don't have your own property yet. And this is all the crucial steps, especially important at this financial time, to understand, to be able to get mortgage ready and get your first property. And it can really make a huge difference. So welcome to the show, Manda Walker.
Oh, thank you. And thank you so much for inviting me.
Well, it's a thrill. I met you first in Financial Joy Academy with Ken and Mary, and I love that community. And it's been great getting to know you as well.
Yeah, no, it's been wonderful. And thank you again for coming on my YouTube channel.
Yeah, brilliant. So Manda, I think it'd be really interesting if you talk about how you got started with buying your own first home at the young age of 22.
Yeah, of course. So basically, I just graduated from uni. I was a trainee accountant. So I started looking at property from a young age. And back then, obviously, trying to buy somewhere, it cost as much as it did cost to actually rent. So I thought, why not? I only had my 5% deposit and off I went. So no, it was really, really good.
And well, if this isn't giving too much away, Amanda, what year was that? Can you remember what the interest rates were, approx?
It was 1999, so
Right.
it was a little while ago. But the interest rates were pretty much what they are now. They're about 4.5. Well, okay, Bank of England rate went up last week to 5%, but my interest rate was about 4.5 at that point.
Yeah. So not too different because what we've had very, very low interest rates for a while. And now
Mm.
people see the current interest rates as really high. They're not really high because we've been through the periods where interest rates were really high. The base rate went up to 5%, as we say last week. But I'm still an advocate that under the right circumstances, it's always a good time to buy. But those right circumstances can vary from person to person. And I think the thing that confuses people, they're working a job, they've maybe got some savings, is what exactly do I need to buy? How can I prepare myself? So let's break this down. And I think if we first, Amanda, talk about how do people prepare themselves? Oh, do you know what, Amanda? I've missed a part out, which is your first property that you bought at 22
Yes.
when the interest rate was about what it is now.
Yeah.
Tell us how that was your first step to getting further involved in property.
Oh, right. Yeah. So as I said, I bought my first property at 22, and that was a two-bed flat. And then by the age of 27, the property had gone up quite a lot. So had a lot of equity. And what equity is, for people that don't know, is the difference between the price of the property and what the mortgage value is. And that gap in the middle is the actual equity, but you can borrow on that. So what I did was, it's called a let to buy strategy, and I actually used some of that equity. So I remortgaged and got more money out of the property, and actually used that to buy a second property, and then changed my original property into a rental property, and then I changed my new property into my home. And then when I was 30, so that's 3 years later, I did it again, and I went in halves with my husband in the house that we live in now, and then I've kept my rental properties. So that's how I sort of got into property.
That is brilliant because that's really accessible for everyone who can buy a property, really. And as the property goes up in value, you can take some equity out of it. So let's just say that you bought the property, let's just make the numbers easy, at 100,000, it's gone up in value to 200,000. You can take 75% usually of.
Yeah, so that's 150,000.
Oh,
So
right.
if your property, so you can take 75% out. So if the property is now worth 200,000, you can
Yeah.
actually mortgage up to 150. So Stephanie, as you said, if your property, let's for math's sake, say you haven't paid off any of that 100k, so just say it's still 100k, even though you would have paid some off, you would remortgage. So if you remortgaged at 150, you'd use the first 100 to pay off the original mortgage, and that other 50 you could use for a deposit for another property. That's how it would work.
Brilliant. And then that was called a let to buy mortgage. And you've got two. So now you've got two buy to let properties and your own home. And without really making this your full time gig or anything like that. And those two properties that you bought, the first one in 1999, will have continued to go up
Exactly.
significantly
Yeah.
in value. And if you can say ballparkish, how much do you reckon they've gone up? You can either do it in percentage wise or figures.
I'm not sure. It's been quite a while, but yeah, I mean, it's easily doubled in value.
Yeah, yeah. Yeah, so it's so great to have these assets that are making money for us, and not only making money, but sometimes they're making more money than we are in our full-time jobs in terms of the value that the assets increase by the equity value on top of the cash flow. So that's really good to know. So then what got you into doing what you do now, the mortgages?
Okay, right. So I was an accountant for about 20 years, and then I got made redundant, and I decided that I just wanted to have a change. So I retrained and became a mortgage advisor. But 6 months into doing mortgage advice, I kind of realized that there was a lot more to it. This was back when stamp duty exemption and all of COVID. So, you know, banks were just trying to, or the economy was trying to sort of keep the banking industry or the property industry going. So they were subsidizing all the rates. So all the rates were, you know, 1%, if not less. And there are a lot of first-time buyers out there that were taking advantage of the fact that the stamp duty, which is the tax that you pay on property when you purchase it, was exempt. So you could buy property up to at least 500,000 and you wouldn't have to pay any tax at all. And then obviously the interest rates were also at an all-time low, and a lot of first-time buyers were sort of asking about help to sort of buy property, but they were approaching me as a mortgage advisor and they wanted to know what deal they could get. But after I reviewed their financials, so I suppose I put my sort of accountancy financial coach hat on, I was kind of looking at their financials and realized they needed a bit of work. So that's how I was coming up with the same things for first time buyers each time. So that's why I created the sort of Get Mortgage Ready club, which is my membership that I run now.
And it's so powerful. We were just having a little chat earlier. Now, people may know that I was a single mum, and so I kind of struggled a bit financially, and I was working full time in a professional inverted commas job, but money just seemed a bit tight. But I'd got it into my head that I really wanted to buy a flat, and at the time I was renting, and I had thought that I was not savvy like I am now in any way, shape, or form. And I thought, right, I just go to my own bank and I asked for a mortgage. And I had been with this bank for donkey's years, decades. And I went to see in inverted commas, mortgage advisor. But the person was very young. Not that you can't be young and knowledgeable, but I don't know what it was, but she really did not want me to buy a property. She was saying she didn't think I ought to buy a property because I would need to refurbish it. I would need to do this. I would need to allow money for that. And she didn't think I was in a position to buy a property. And reflecting back on it over the years, I think it felt like she didn't have a property and she didn't want me to have a property either. And for a while, I really did take that as the gospel, because I thought, well, the bank, when really it's just actually one person at the bank have said that even though they've seen my account for decades, which was in good standing, don't get me wrong, they think that I'm not good enough to have a mortgage. And I thought that was just it. And then I happened to see something and I saw, oh, you can go to other banks. It sounds ridiculous that you can go to other banks and get a mortgage. And actually, at the time, the new kid on the block was Northern Rock. And they actually had a branch in Edinburgh where I lived at the time. And I went in there and no problem at all. We all know what happened there, but no problem at all. Got a mortgage. And it really changed. It really changed everything. So I think what you're doing with the Get Mortgage Ready Club is so important. And can you give us a bit of an outline of what things do people need to have in place, for example, credit wise?
Yeah, no, of course. Just going back slightly, Stephanie, to what you said, I think the percentage is about 70% of first-time buyers literally just go to their bank. So as you say, they might just be told no, they can't get a mortgage at all, or they might be told they can get a mortgage, but it won't be the most competitive rate. So I think that's why you would need a mortgage advisor, because we're whole of market, which means we can go to every single lender. All lenders are willing to lend you different amounts, which not everybody knows because they have different criteria. And also, all lenders have different rates. We don't, even though the Bank of England rate is set at one rate, which is the 5%, which we said, all the other lenders, depending on how much of the market they want, will actually either reduce their rate below the Bank of England rate, or some of them obviously above the Bank of England rate. So that's something just to be aware of. But in answer to your question, first thing I'd like to mention is credit. Now, I think there are two sort of ends of the spectrum here. So you've got the first-time buyer that has literally, just been saving up their deposit the whole time, has never had a loan, has never had a credit card. And then when we run a credit file on them, it just comes up with them literally having no credit footprint at all whatsoever, which means that banks don't really feel comfortable lending to them, because especially if they're sort of buying in London, where I'm based, they could be buying a property for sort of 250, 400,000, and if they've never even had a credit card or even an overdraft, banks are really uncomfortable because they don't think, they are worth the risk. They're saying, look, at the end of the day, at least if you had a credit card, even if it was £1,000 and you spent £100 a month and were paying it off in full every single month and building up your credit, then I'd be able to say, okay, I've seen you manage credit. And then, so there's the no credit. And then there's the low credit, which are people that have literally just used up their credit. So they've got a low credit footprint. The other thing just to be aware of, and this is why I always suggest people look at Check My File, and I can, Stephanie, I can send you my affiliate link for that. But basically, the reason why I say to use Check My File is it runs off all three of the credit agencies and it will look at everything. And when you're looking at people's credit file, that's what banks look at. They look at the credit file. They don't look at the credit score. So all those credit cards that are out there saying, we'll boost your credit to 999 and all that kind of thing. If you have overutilized your credit, which means, you've got a higher credit, like cards, loans and everything higher than your actual salary, even though you might have a really good credit score of 999 because you pay it off every month and you're very responsible and you've got a lot of credit, so they've obviously increased it, the bank will still look at the actual whole of the file and sort of say, based on, how much you've committed, they still don't want to lend to you. So you just really need to look at several things when you're looking at your credit. The second thing is bank statements. You have to make sure they're clean bank statements. So what I mean by that is don't do gambling, don't have sort of a car with a really high HP and you've missed a few payments, don't have money going in and out. I know a lot of people like to sort of help out with the family and that kind of thing and give money, but don't have 20 what are they called? Standing orders, all to different members of your family and things like that. Because as far as they're concerned, even though you may just give the money on the odd occasion or whatever, the fact that you've set it up as a direct debit or a standing order or whatever, they will count all that as a financial commitment, and that will reduce your affordability as well. So that's something else. Another thing is your pension. And when you're looking at your pay slips, they do look at all pay slip deductions. So one tip I'd give you is when you're looking to buy a property, don't get the biggest pension that you can contribution. Just keep it to a minimum till you've bought your property, you know how your finance is going to lie, and then maybe increase your pension contribution. Because at the end of the day, they look at your net pay. So even though you could be on sort of 25k, for example, they'll look at your pay slip. They look at the last 3 months pay slips. And if you've got a lot of deductions coming out of there, that also will reduce your affordability. So that's your credit file, your bank statements, and your pay slips.
I love that. Credit file, bank statements, and pay slips. Now,
Yeah.
this is why what you offer with the Get Mortgage Ready Club is so, so important, because you've already covered there. And I think just being able to give somebody your bank statements and say, is this okay? Is everything good here? It's just so you get the eye over it before you go to your bank. Sometimes you'll be able to look at it yourself and see that things are wrong. It made me laugh when you said about the gambling, because we actually do our own referencing in-house. We've got a small letting agency. And so our team looks at the bank statements of everybody, and it really gives you such an eye into who somebody is,
Mm.
because the two things that determine your values is, or that show your values, is how you spend your time and how you spend your money. And how you spend your money is on your credit card. Sorry, it's on your
Bank
bank
statement.
statement. So it's a real good insight. You've given some insights into the mistakes people make. Is there anything else you want to say, Manda, about the mistakes people make?
One, and I'll just tell you a very quick story about a young gentleman. And I just felt for him because when he was at university, he's the one who put his name down on the utility bill as the main name. And then he was renting, like house sharing with some friends. And then when he moved out, he just assumed, and you should never assume, that the next person would put their name on that account, and they didn't. And of course, they didn't pay the bill because it wasn't in their name. So when I went to get him a mortgage, which only was last year, we couldn't get a mortgage because he had that utility bill had been sitting outstanding for quite a while, to the point that they'd be getting CCJs, and the court had been asking for the money and been sending letters to the address he moved out from like 3 years ago. So when you look at your credit report, don't just look for whether your credit is whether you recognize all of your credit cards and your bank accounts and things like that. Also check the addresses to make sure you're no longer there anymore. Another thing is check your financial affiliates as well, because I've been in a lot of situations where especially the ladies out there, they've gotten divorced or separated or whatever. We really do need to sort of make sure that you've severed that financial link, because otherwise their credit file affects your credit file. So just really look through your credit file and just double check. And when you move out of somewhere, sever all ties.
Mm-hmm.
So if it's utility bills or your BT bill or whoever your broadband is, or whoever, make sure when you move out you sever those ties. Take your meter readings. Make sure at the point of time where you've left, so your financials end at that point.
Absolutely. Mand, what you're saying is so important. And I think if you're listening and you want to own assets, you want to own your own home, you want to own investment properties, you have to own your financials. You have to own your credit. You have to get these downloads that you're talking about, Mand. Now, I'm speaking as someone who did not always do this, who was clueless entirely. But as things have built up, it's become very important to us all the time to regularly check our credit. So, Amanda, was it Check My File that you suggested?
Yeah, that's what I use because it's a multi-agency report. And as I said, I do have an affiliate link. It doesn't actually cost them anything extra, but they can do it through me if they'd like to.
Well, what I'm suggesting is that everybody join the Get Mortgage Ready Club. it is a superb club. And as you can see, Amanda can give you insight for your situation to really help you to get that clarity and actually take those steps towards getting mortgage ready. If you're already with your deposit saved and you're ready to take the next step, or if you're starting from zero or even minus figures and you want to start saving up, saving your deposit to get your first property, then Get Mortgage Ready is for you. And it's an incredible value. It's an incredible value. Tell us a little bit more about Get Mortgage Ready and what people can expect inside, Manda.
Yeah, of course. So the Get Mortgage Ready Club I've only just launched it. So for the first 100 members, it is £27 a month. And what you will get within that is I will come on and do coaching every other week. So you can submit your questions and I'll answer them on a coaching call. There's also online support. There's online courses, so the A to Z of mortgages. So it helps explain all the different terminologies, which can be quite confusing. I do, as Stephanie has said, a financial review. So I look at your credit file, I look at your bank statements, and I give you tips and tricks to improve that. I'm adding content every single week, so different courses depending on what people ask me about, so different schemes. So for instance, if you're interested in right to buy, or you're interested in shared ownership, or any other sort of schemes that are coming along now, the help to buy is over. The banks are talking, the government's talking about introducing a new scheme. I'll be able to do a video on that. So that's what it's basically about. There's also a community, so everybody can be in touch with each other, which I run via Facebook, and people just can talk to each other and sort of get advice. And I'm also in there on a daily basis, happy to sort of answer any questions that people have got in between the fortnightly coaching calls.
Well, I just nearly fell off my chair when you told me about the investment that people need to make to get in the Get Mortgage Ready Club. I wish you'd been around years ago when I had gone for that meeting at my bank and been told, no, I don't think you should get a mortgage, because it's so phenomenal. And it's £27 a month, as Manda says. So you can't even go out for dinner for that. So it's great to be part of and actually be investing in your future, investing in yourself, and investing in owning that asset. And although the interest rates are higher than they were super low, it's still a great time to buy for many people. And the value of your property can double. Manda's had hers since 1999. It could be that you buy yours in 2023 or 2024, and in 20 odd years, you're talking on a podcast how your property doubled. Maybe it'll even triple in value. So that a 5% that you're paying, or 6%, or whatever it happens to be, will be so worth it. Manda, what would you like to say as we're coming to a close? Is there any parts of it that we haven't discussed yet or that you want to mention?
I just wanted to say sort of thank you for having me. I've really, really appreciate it. As I said, I'm more than all I want to do is sort of help. I think everybody has a right to own their own home, and you shouldn't be told that you can't own a property. I think that is just wrong on so many levels. And I think sometimes certain people are discriminated against, which I think is unfair. So that is why I kind of make a point to sort of put myself out there, because a lot of people meet me and they're like, oh, I didn't think mortgage advisors were like you. I try and be as relatable as I can, and I just want to help, because I just think everybody has a right to own their own home.
Exactly. And as Black women, I think in the Black community, I was surprised to learn recently that only 32% of Black people in the UK own their own homes, compared with 64% of white people. And I think partly cultural, where we commit to our money, our education, our knowledge of finances is not always where it could be, and certainly mine wasn't. But now with the internet, with Instagram, with groups such as yours, Get Mortgage Ready, all the information is much more readily available than it was. On that note, I want to mention Manda's website, which is, I'll put this link in the show notes, and it'll also be in the link under the podcast, and it's mortgagecoachonline.co.uk. And also, Manda is on Instagram at Mortgage Coach Online. And you can see the video of this episode and me and Manda. That is at episode 186. So it's rentsuccess.com/186 to see us in full technicolor. So, Manda, thank you so much for coming on. And what would you say? Oh, you've given words of inspiration and encouragement. Everybody should own their own home. Thank you for joining us today. And if you want to own
Thanks
your
for
own home,
inviting me.
it was my pleasure. And you don't already, join the Get Mortgage Ready Club for less than the price of a meal out. Okay, that's it for this week, guys. Remember, believe bigger, be bolder, be a game changer, and I'll see you next week. Bye for now.